We have Alexander Redman, Chief Equity Strategist at CLSA, joining in. Alexander, thank you very much for joining in. This is Reema here. I think that's the big question now. What we've heard from China and what perhaps might come in the future. Is the Chinese market, should we look at the Chinese market tactically, or is it good structurally for the next 3 to 5 years? Weigh in with your opinion.
Yeah, very good morning. I think that is the key question. What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. But I think what really differentiates the current episode is going to be whether you get the fiscal follow through from the Chinese government. We've had 4 full storms, so 4 bear market rallies in Chinese equities since March 22. And each one has petered out after about 3 or 4 months and after no more than about 40% gain, as the market has come to the realization that the fundamental economic challenges that China faces have not actually been resolved. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. If you look at the current inventories with developers versus the current rate of sales, it represents about 3 years worth of inventories that they've yet to clear. And that doesn't include the 12 to 15% of the housing stock in China, which has been bought speculatively. So add all of that up and you've got a lot of inventory to digest, and you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects.
So, Alex, great to have you with us here on the program. So you're saying we need to obviously watch the property market very carefully to see if there is any sort of a durable rebound. Is that going to be the best indicator of whether this is the real thing? What else will tell us that this is the real thing?
I need to see multiple changes and indicators. I mean, what we need obviously is for property prices to begin to turn up. Certainly, I mean, this is critical. 51% of household wealth in China is still sitting in property. You know, are you, as a member of a Chinese householder, going to feel sufficiently confident to go out and acquire more property if prices are still falling? You know, highly unlikely. But equally, what I would like to see is consumer confidence broadly begin to come up, and also importantly, consumption. And this again is, I think, a key topic, because as we're all aware, China's economy at the moment is still remarkably imbalanced away from consumption. Its consumption share of GDP is only about 56%. If you look at the other large global economies, India included, it's between 70 and 82. So China needs to take policy measures which will unlock savings. At the moment, you have about 115% of GDP sitting in savings. So much of that could be deployed into consumption. It's just whether the government is prepared to take those steps to actually unlock China's consumption potential going forward.
But would you say to some extent this China rally that we've seen is a bit of a hope trade, because this fiscal stimulus package of 2 trillion yen, which has been talked about, hasn't been officially announced by the government there?
Mm-hmm. No, you're right. I mean, what we heard, the genesis of the report, I think, came from Reuters. There was 2 trillion renminbi, split roughly in half. I mean, the idea was that half would go to refinance local governments and allow them to carry on the purchases of excess real estate inventory, and the other half aimed more at stimulating consumption. But as you say, this remains unformulated. I mean, last Tuesday, you had a relatively precise delivery on the monetary policy side and regulatory changes from the PBOC and the securities regulators. And then on Thursday, we had some sound bites that came out of the September Politburo meeting, all about arresting the falls in real estate and trying to encourage spending in China. But as you say, pretty light on detail.
Okay, so got that. So you've spoken a good bit on China. Alexander, the question really is for us sitting here in India is what does it mean for us? And we've seen the first sign of real FII selling in the last 2-3 days. And I go back to a call that your India analyst Vikas Jain made, that he said the quote-unquote Modi stocks, they are perhaps most vulnerable to profit taking. So what's the stance on India?
I mean, India's been on a roll for several years now. You know, we've been a structural overweight. We've enjoyed that rally, but I've always been testing that because there is a certain amount of complacency around, or at least has been around the Indian equity market story, and a certain amount of consensus. And there are three things which I've been looking at to break that complacency. And essentially, it's an interruption to retail investor appetite. A large pickup in issuance. In other words, you get IPOs to the level that you can swamp the secondary market. And also any changes to the oil price. And what you've seen actually in the last week or so is all three of those come into play. So you've seen regulatory changes which have dampened the ability of retail investors to participate in equity derivatives. You've seen the geopolitics in the Middle East become more of a flashpoint, and that's aggravated the oil price as we all sit now waiting for Israel's response to Iran's missile strike. And you've seen significant pickup in primary traffic. So, the volume of IPOs and secondary issuance has picked up as well. So all three of those, I think, in combination are certainly testing the Indian market. And as you say, compounding that, there's certainly some scope for rotation. Now, I think we need to be careful here because if you look across emerging markets, India is one of the most domestically owned markets, and that is quite a moat for India. It's very protective. 83% of the market is owned domestically. I mean, if you go to Latin America, that number falls below half. And so with only about 17% of India owned by foreigners, and most foreign investors actually sitting, at least anecdotally, at underweight positions because they find it difficult to stomach the valuations, I think there will be relatively little drawdown on Indian equities to rotate into China. I see a more obvious source of that being Japanese equities or Korea or Taiwan as we get towards the end of this tech cycle.